You probably already have the knowledge to be a consistently profitable trader and get funded. The only problem is you're overcomplicating everything. You've added all of these unnecessary fancy terms, these bells and whistles, but you're forgetting to have the basics truly nailed down. Trying to trade order blocks, breaker blocks, supply demand zones, support resistance, trend lines, fair value gaps, liquidity sweeps, the liquidity inducement theorem, the market maker theorem, accumulation manipulation distribution, Wyckoff pivots, key levels, sweep zones, flip zones, change of characters, OTE fib, open high and low of the weekly, open high and low of the daily, Asian session range, London session range, New York session range, and you've got all of these fancy terms, these fancy bells and whistles that you already know, but you're forgetting to put the basics together. Your charts and lines are all over the place. You've probably got 12 different entry criteria. Some of you probably even trying to trade rainbow cycles, and yet you are still in pursuit of more information, watching countless videos on YouTube from your favorite trading gurus, because live stream trading and signals at the end of the day does not lead to long-term consistent profitability and long-term sustainability. I know this because I went through the phase myself. I used to be a live stream trader, I used to be a signal provider, and I had one of the best groups you could probably find with a really good consistent gain in terms of percentages, risk to reward, and risk management. But even the best groups in the world, you gain to have a few traders in your groups that aren't going to be profitable. And now you're stuck with information paralysis. You've been watching endless videos on YouTube. Now, I want to ask you guys one question to put your perspective and change your perspective on this. Imagine you're about to start a race around a racetrack. The top prize for first place is $1 million and last place is $20,000. Either way, you're guaranteed to make money by taking part in this race, but you have a choice of two cars: Max Verstappen's Formula 1 car or your mum's trusty Toyota Prius. Which one are you going to pick? Well, most people would choose the F1 car because they want to try and win the race for that top prize. But you know what's going to happen. They're not going to know how to drive the car, let alone even climb into the car and understand what a single button on the dashboard does. They're not going to know to warm up the tires, get enough heat to even get around the first corner. And they're either going to spin out or crash out, and they're not going to win anything. And the best part is, the next month, they're going to get to do the race again, but they're going to repeat the exact same thing. They're going to take the F1 car, try and finish the race first, because they won't drop their ego to drive their mom's trusty Prius and go around the track calmly, slowly, and safely to finish the race and take their guaranteed $20,000. With the potential upside that some of the others in the race will crash out in their F1 car and they might win more than $20,000. Now, what does any of this have to do with trading? Well, there is so many traders out there in the world at the moment in this exact same race, trying to catch crazy 200R trades, or these live stream traders that absolutely go wild every time they take a win, when in reality it's an ego game. It makes them feel better that they think hundreds of people now know that they are a good trader, which even then they're using that to their advantage to promote an affiliate link for a prop firm or a broker to show this facade to their audience to make money off of them. And quite frankly, it's fucking stupid. It's asinine. And prop firms are now offering minimum of, $400K starting capital, and just a 5% return on that is $20,000. And I can guarantee you that all of you have the capability to make a 5% consistent return on average every single month. So stop trying to jump into an F1 car with all the bells and whistles and fancy terminology when you can take a proven, simplified approach rooted in the basics that will change your life. And you don't need to win that race to change your life. If you can consistently, just slowly and calmly get around that racetrack to get consistent gains guaranteed every time, why do you think FTMO has a worldwide leaderboard that resets every month? It's because they know they are going to tap into traders' egos, make them over leverage, over risk, and inevitably blow up their accounts, so that FTMO can make more money off of their failed challenges. In this video, I'm going to prove to you just how powerful simplifying the basics is, and how important it is to rather climb into your mum's steady Prius rather than jumping straight into the F1 car. I'm going to show you how simple institutional supply and demand trading can be so that you can start making actual progress today. What's going on, awesome people of YouTube? My name is Jay. I'm the founder of Mechanical Methodology Funded, aka MM Funded, which is a community and mentorship program that I created over a year ago that created over 200 funded traders consistently in 2023. MM Funded doesn't only help traders get funded, but it helps them create and bank consistent profits on a monthly basis, using the power of mechanical, rule-based, disciplined strategies. And look, I'm not sitting on my high horse here trying to preach to you. I'm just as guilty as anyone complicating trading strategies, making a mess of it, as I know for a fact every successful trader has to go through that phase. But the best traders and best trading is always keeping things as simple as possible. And right now, you are probably in one of two categories. Firstly, you're that trader that overcomplicates everything. You're stuck with paralysis analysis. You're constantly searching for videos on YouTube to learn as much as possible while forgetting about the basics. At the end of the day, leading to fear of execution. Or two, you are just blindly trading entry models on every single zone out of complete fear of missing out. The master traders are somewhere in the middle of that. They have a very specific set of criteria and a simple criteria that they use, and they execute that when those high probability setups present themselves. And that is the balance that I'm going to help you find and strive in the rest of today's video. Let's go over a quick crash course on the basics of market structure and institutional supply and demand zones, whatever name that you want to give them. And what exactly are we trying to do here? We are trying to identify where the big money, millions and billions of dollars, that is pumped through price every single day by institutions, banks, investing, and where they're entering and exiting the market, so that we can be trading on the right side of order flow, right? So that we can find those high probability moves. The easiest way to identify that is to look for those institutional levels or supply and demand zones that creates a break of structure. Because an area of interest, a supply or demand zone or institutional level that can create a break of structure on a liquid instrument is a very high probability and valuable area of interest, or POI, which stands for point of interest. In its most basic form, when price is in a bullish market or a bullish trend, what price will be doing is it will be creating a series of demand zones underneath strong low points with the expectation to take out our draw on liquidity weak high points. After a new break of structure, price will always occur a pullback phase to fulfill orders in the previous structural range to rebalance supply to mitigate the demand levels that are in control to continue targeting those weak structural high points. Rinse and repeat, new break, and the pullback event occurs to mitigate demand areas in the previous structural range, again, to rebalance supply, to continue targeting those weak highs. Why does price always occur a pullback phase? Well, that's because markets will never move in one direction forever. That's not how money moves in price. There always needs to be a rebalance of supply or demand in a bearish or a bullish trend to continue in the direction of order flow. In this more basic form example, supply is currently failing because demand is currently in control, meaning the institutions of price are currently involve a much higher level of buyers introduced into the market. So when price pulls back to that, this is a strong low. The expectation of price is to protect these strong lows and not violate those strong lows. And we ideally want to be buying where these demand levels are, where demand and buying power is currently in control. And we want to be targeting weak structure. And this will keep happening until eventually a strong low is broken to the downside. And we now create new strong highs ready to enter a bearish trend market. And this will keep happening until price breaks the strong low to the downside, creating a new strong high. This being a strong high, being the most recent high that took out a previous strong low. So instead of creating weak highs, we're now creating weak lows in a bearish trend example where supply now takes over demand. All the signals is that the institution's buying power is now finished, selling power is now starting to enter the market. So we know that would be the better side of price to stay on when price mitigates areas of supply at the strong protected highs with the expectation to target the weak exposed lows. And what we want to do is, after that break of structure to the downside and a trend shift, we want to identify those supply zones that are creating those new breaks of structures to the downside, because this is where our highest probability trade setups will be lying. And this gets super, super powerful when you start trading alongside
alongside and hold onto this framework, because in reality, price action is slightly more complex, not looking as clean and as simple as this basic example. Within this more basic example, there is smaller structure, what we call internal structure, that happens within these ranges that starts to look more like this. Smaller breaks of structures, supply and control, catering for pullback phases, supply takeover, demand now in control. Internal structure is now creating new strong lows, signaling that this overall pullback is over. We're ready to target the overall higher time frame swing week high. So this starts to allow you to start trading both pro trend in alignment with the higher time frame intentions, as well as counter trend, trading these pullback phases after the previous swing break of structure, because we can anticipate price to shift bearish interim on a lower time frame to cater for the much higher time frame bearish leg into the higher time frame demand that is currently in control. The problem with most traders is they forget how basic this is and how super important it is to understand these simple basics of market structure. Because in a bullish example, traders are continuously looking to keep shorting when they don't understand the current story of structure, and that the longer term expectation is to rather target these highs. So once we understand this, we know to stop continuously looking to short price and rather look to get on the long side of price in alignment with the order flow and the current bullish trend. And this is exactly what traders do that don't understand these basics. They continuously look to short of these supply areas in the middle of the range, for example, this supply here, but without understanding that we've now mitigated the strong low demand level with the expectation to target these weak highs. We know there's a very good probability that the supply is going to fail and demand is now going to take over with the expectation and the rules to target our weak structural highs. Traders are trying to force trades within here, looking to get short to try and make quick profits without realizing they're trading against the money and against the order flow. So back to the basics. We want to trade from strong structure and target the relative weak structural points. So simple, so effective, yet so many people forget it and don't do it correctly. Vice versa, in a bearish example, when supply is heavily in control, traders continuously forgetting to look at the higher time frame structural narrative, continuously looking to long price off demand levels with internal breaks of structures without forgetting the fact that price has now mitigated strong protected highs in an area of supply with the expectation and good probability of demand to now fail and to let supply take over. Again, on the wrong side of money and on the wrong side of order flow. Even these supply areas here, where supply is in control, the expectation is to target these weak lows, where traders are shorting from the supply and they're taking one or two losses, which is 100% fine. That's trading. That's how it works. Before you catch your long runner to continue targeting those weak lows. What I'm saying is the highest probability is to always remain pro-trend, trade from strong protected structural points, and target the weak structure. So another simple and effective and powerful thing that a lot of traders forget is how to manage your expectations of what a zone will do when price gets there. So for instance, when we're initially in this bearish swing range with this previous strong high, this break of structure, and this weak low, we're expecting a swing pullback to supply to reverse and continue targeting the new created weak lows. So essentially we're looking for short trades to target those weak lows. Simple enough, right? So we can identify an extreme supply zone here and a more recent supply zone here, because both of them did what? They both created a break of structure. The recent created the swing break, and the extreme also created a swing break of structure. The more recent ends up holding and prints confirmation, happy days, and we continue to target the weak lows from the more recent supply. New break of structure, same thing. New range, our new strong high, our new weak low after that pullback phase. New break of structure to the downside. So same expectation remains, is for price to pull back into supply that is in control, to remain protected and to protect the strong highs, and to continue targeting our new weak lows, because those should have high probable institutional involvement. But as we know, a market's not going to remain bearish or bullish forever. There is going to be the eventual period where price will then shift bullish take out those strong highs, create new strong lows, and put demand in control. And there can be various reasons because of this. Perhaps price is currently in a higher time frame pullback phase where interim internal supply is in control, but the overall higher time frame trend is still currently bullish. So perhaps we mitigate a higher time frame demand zone at a higher time frame strong low, so we can now have that expectation of the lower time frame internal order flow to start shifting bullish and to start putting demand in control by violating those strong highs and creating new strong lows. All right, so higher time frame POI mitigation at the strong low, expectation to protect the strong low and target the higher time frame weak highs, mitigation of that demand, price pulls back into supply. So now, without looking at this higher time frame picture, our current anticipation would be for price after that break of structure, for the pullback phase to occur into institutional supply at the strong protected high to continue targeting those weak lows, right? But this is where once we start to incorporate that higher time frame narrative, which we're going to go over a few examples in a bit, we can start to manage our expectations better. We know that there's going to be good probability eventually for the supply to fail. Supply creates a reaction, but instead of targeting the strong low, we then create a break of structure to the upside, creating a new strong low and a new weak high after that pullback phase, with demand now in control. So what expectation does this give us? Well, this gives us confirmation that the higher time frame bullish pro trend has given confirmation to continue holding and continue long to target the higher time frame weak highs. And this is the point where I see tons of traders making mistakes, because what traders will do is they will look left and see these older areas of supply. And they immediately starting to look, okay, well, price has created the break of structure. We now have a liquidity buildup for these areas of supply. Supply mitigation, fantastic. We can now continue to ride price shorter, but they simply are missing that entire story of price and where order flow needs to go. Whereas what we know now, with the expectation to target these higher time frame POIs, internal structure has just confirmed so, demand is currently in control. These are now strong protected lows. The anticipation or expectation of price is to not target these lows, but to rather continue targeting these weak highs. So we know these older areas of supply, we can anticipate a reaction, but just to cater for the pro-trend pullbacks and not the overall higher time frame pro-trend bearish movement. So therefore, traders are looking to get short here, target these downside movements, getting involved in shorts, but constantly getting stopped out. New supply mitigation, still getting involved in shorts, stopped out. Why is that so? Because they're on the complete wrong side of price and trading against the order flow. I want you to make a note of this. When order flow shifts bullish, old supply zones do not become valid institutional levels, they simply become reaction points. That also doesn't make looking for shorts from these areas of supply invalid. You can look for shorts from here if you want to, but this is where you need to manage your expectation. We know that it's going to be unrealistic and against the order flow to target shorts all the way down here at potentially lower levels that you are seeing, but instead we can look for shorter intraday trade, mechanical 2 or 3 hour trades to ride these pullback phases, with the understanding that price is due to mitigate demand, protect these strong lows. We rather then want to look for our trade plans to remain long on price to target the higher time frame structural weak highs. Just to recap that, all these old supply zones are doing is just providing a simple reaction for price to pull back into what is actually in control, and that is currently demand. Likewise, continuing with this, we create another break of structure, mitigation of old supply, traders looking to go short and potentially ride price to lower levels. But in reality, all the price is doing is catering for the pullback phase into what is truly in control. These strong protected lows and these demand levels to continue pro-trend long. Let's have a look at a live example. So over here on my charts, I've got Euro USD on the daily time frame, which is our highest time frame or swing structural time frame for an intraday trader. Now, essentially how price moves is there are 3 different structure types that occurs in the mechanical market structure, which is essentially what I'm teaching you in today's video. So previously, if we backtrack on Euro USD back in December 2022, we created a new daily break of structure to the upside. If we want to backtrack more, we were in a bearish trend with breaks of structures to the downside, pullback phase into supply, new break to the downside, pullback phase into areas of supply, new break of structure to the downside, mitigation of higher time frame demand at a higher time frame monthly strong low. So although at this point in time we had a break, strong highs, new week lows, we had a pullback into supply, reaction, and then failure, new break of structure to the upside, catering for the much higher time frame weekly pullback phase after our previous weekly break, our weekly strong highs, weekly supply mitigation. Following this through to more recent times, new daily break, strong lows, pullback, mitigation into extreme demand, internal break to the upside, pullback into demand to continue follow through and target those new daily week highs. New daily break of structure, daily pullback phase occurs, mitigation into extreme daily demand, internal shift to the upside, demand to supply takeover, pullback into demand to continue internally to target those new daily week highs. New daily break of structure, pricing occurs the pullback phase. But here, instead of respecting the strong lows and respecting demand, we broke structure to the downside. What does that mean? Price is now shifted into a bearish trend, creating new strong highs. After the daily break of structure, what can we anticipate is the daily swing pullback phase with an internal shift to the upside, demand takeover, and we continued through with this to mitigate premium areas of supply. After that, creating new week lows, so we know the eventual anticipation of price is to target these daily week lows. Premium supply mitigation, internal structural, now shifts bearish, creating new internal strong highs, internal pullback into premium supply, fractal change of character, supply and control, confirmation to target our internal week lows. Internal structure aligned with the higher time frame structure, so we know on EURUSD that the longer term expectation of order flow is to now respect this internal structure and target our daily week lows. Now, what I'm going to show you in today's video is a mechanical, simple rule-based way to identify these structure types so that you can start to remain on the right side of price and understand how powerful this can be. So having a look at EURUSD right now, comment down below what you think is happening. Prices most recently created the internal break of structure to the downside. New strong high, highest point after the pullback that created the next break, strong high. Price is now mitigated older areas of demand, which will cater for that internal pullback into supply that is truly in control. So we understand that it's going to be unrealistic to start looking for longs from this level of demand and target areas way up here, because that is against order flow and against the expectation of where price needs to go, because we know we want to trade from supply areas at strong protected highs to rather target the weak exposed lows. So therefore, we don't want to be buying these weak but lows. Yes, price may get a reaction off these demand levels, but remember, they're just catering for internal pullbacks into supply that is truly in control. Again, the rule of order flow, price is not going to flow in the same direction forever. It's going to move in the form of strong highs and weak lows, mitigation of supply, and follow this through until else changes. What we want to rather do is look for supply zones that have created the previous breaks of structures, new break, supply in control, mitigation of supply, confirmation printed, supply in control internally within this internal range, new break, pullback into supply, new break, pullback into supply, and we want to look to follow this through to rather target our weak lows rather than looking to buy from these areas of demand. Because I can promise you, this reaction of this older area of demand now, we most likely had on a lower time frame a beautiful mitigation, change of character with lower time frame demand and control, pullback into demand to continue long. So I can tell you a ton and millions of dollars are going to be pumping into EURUSD right now to look to take longs, but these traders essentially are trading against the order flow and against the structural trend of price, where we know here at Funded that supply is currently in control. We rather want to stay on the right side of price, look for shorts to target our weak structural low points from the strong protected highs. So again, once you learn to understand the basics of this, once you learn how to mark this up, which will come through practice and time, your trading career will be essentially moved into a whole different realm, and you will automatically be moved onto the right side of price. Why is that so? Because these are the areas where the injection of institutional selling power and supply has taken control. So these are really valuable areas to look for high probability trade plans. And all I'm saying is follow your order flow, follow the structure, look for the zones that are causing the breaks of structures and remain on that side of price. Let's take another example of XAU USD gold. All the way back in August 2023, we were creating daily breaks of structures to the downside. New daily break, daily internal pullback, new break to the downside. Supply and control, pullback into supply, new break of structure to the downside. Again, strong protected highs, pullback into those strong protected highs, supply, internal shift to the downside, demand internally failed, pullback into that internal supply as confirmation for price to continue targeting those weak lows. New break of structure to the downside. Daily pullback phase occurred, mitigation of extreme supply at the strong protected highs, internal shift to the downside, internal pullback into supply to target those daily weak lows. We then created mitigation of the higher time frame weekly demand at the weekly strong protected lows. So this is where, again, we need to manage our expectation. Although the daily is currently bearish, we know that after weekly strong protected low demand mitigation, there is good probability that the daily could now shift bullish. Okay. Now, daily break of structure, mitigation of weekly demand, daily pullback starts. Instead of respecting supply to continue targeting those weak lows, we then broke structure to the upside. So what does that indicate? Well, that indicates that the order flow has now shifted from bearish to bullish in alignment with the higher time frame trend to target those weekly weak highs. New daily break, mitigation of old supply, catering for the reaction point and pullback into demand that's in control. So here in the specific daily range, daily strong low, daily weak high, we had three demand areas. We had the extreme, we had a more recent, and then even the most recent demand. Price pulled back into the most recent demand takeover, daily change of character, pullback into demand to continue targeting those daily weak highs and also to continue targeting those weekly weak highs. Even then, so new daily break, pullback into extreme demand, new daily weak highs created, reaction, pullback into that change of character daily demand to continue targeting those weak highs, remaining pro-trend. And this is the mistake that most traders made on XAU USD is after this break of structure or internal break to the downside, supply is in control. And yes, it's 100% valid to look for shorts of these supplies. But here again, we need to manage our expectation. We know these are strong protected lows. So the eventual anticipation would be for price, for demand to start overtaking supply and continue to target those weak highs. So it's going to be unrealistic to look for shorts of these areas of supply against the order flow to target areas way down here, because we now know that this is the complete wrong side of price. All right, shift in order flow, new internal strong lows, price targeted those weak highs. And it's really simple to follow this through. All you're looking for is the zones that are creating the breaks of structures, creating strong protected lows. So we already know that we immediately on XAUSD know that longs is going to be higher probability. Why? Because the lows are currently strong, demand is in control, the highs are currently weak. Coming back to our basics, we want to look for trade plans from the strong protected lows to target the weak exposed highs, and vice versa for a bearish market. We want to look for shorts at the strong protected highs in areas of supply that is in control to target the weak exposed lows. Once you start to see this, you don't even have to look at lower time frame structure. We know there's a daily break of structure. We have a demand area here as well. We can set limits just on the daily time frame to target our weak highs. And we could also have limits on our more extreme zones. So in this scenario, let's say price mitigated our more recent, failed that, we would have had a -1, tagged into our limit on the extreme, price then continues in the expectation of direction to target our weak highs. So although we had a -1, we then had a +5R after that. So even though we took a -1, we're still profitable. And again, this is the nature of trading. You're going to take -1s and you're going to take your long runners. And keep in mind, this is without even looking at the lower timeframes, just sticking to the daily timeframe. And I mean, on a $100,000 prop firm or funded account, a 1 to 6R, if you're risking 1%, that is a 6% return. you can calculate the rest. And the same thing with Euro USD. New daily break of structure. We can understand there will be multiple demand areas, a more recent and a more extreme, but we know in this scenario, the more recent didn't create the break of structure in terms of swing structure. It would be higher probability to look for longs from the more extreme strong protected lows to target our weak highs. And there we go, mechanical 2.7R. New break of structure, new extreme demand created. Also, tons of demands created within the equilibrium of the range. So even if you set a limit at the more recent, you would have had a -1. And if you had another limit at the more extreme, you would have had your full runner of a +5R trade. So even on the daily time frame, without looking at the lower time frames, you can catch awesome mechanical 3R trades. All right, new break of structure to the downside, more recent supply, more extreme areas of supply. So we could set limits at the more recent, which again, we would have had a -1, which is beautiful. It's the nature of trading. Mitigation of the extreme, limits at that extreme, stop above the high, targeting our weak lows. We currently could have been in this long runner, just again, looking at the daily time frame. Keeping it to the basics, because this is the zone that led to the institutional break of structure. With strong protected highs, new weak lows, expectation to target these weak lows. So therefore we know shorts is definitely going to be higher probability on this particular market. And of course, there will be a point in time where this trend can potentially change and we create new strong lows, new weak highs after the break of structure to the upside. Then all the changes is the anticipation of order flow, is to continue targeting these weak highs again until else changes. So let's have a look at how we can capitalize on this market structure system on the lower time frames. Let's drop down to the 4-hour time frame on Euro USD or the Euro dollar. On the 4-hour time frame, we now know we've had a daily break of structure to the downside, so we can eventually anticipate the start of that overall daily swing pullback. And we identify that with our 3 structured type time frames. The 4-hour being the internal time frame of the daily swing time frame, which confirms the start and end of pullbacks and the start and end of pro trend phases. So over here we can see we had our daily break, previous 4-hour break of structure to the downside, pullback into supply, mitigation of supply to continue targeting the weak lows. Pullback phase, mitigation into supply to continue targeting those weak lows. So although in this point in time, supply is still in control, this is where we need to manage our expectation, that we know that there's going to be a good probability and any point in time right now where supply is going to be taken over and new strong lows are going to be formed. Over here, new break to the downside, strong high, weak low, but instead of pulling back into supply and continuing to target those weak lows, we had a break of structure to the upside. Now we know this has signaled the start of the overall daily swing pullback. Pullback phase into extreme demand, also a more recent demand here. Mitigation of the extreme, internal break to the upside, internal pullback into demand, to continue targeting those 4-hour weak highs. So just alone, we could start to set limits on these extreme areas of demand, even the more recent if you want to, which again would have been a -1, which is the norm of trading. It's 100% fine. Tapped into our extreme to continue targeting those 4-hour weak highs. Okay, new 4-hour break, extreme demand created, pullback into extreme demand, internal shift to the upside, pullback into internal demand to continue targeting those weak highs. Again, we could set limits at just the extreme of these 4-hour strong protected lows to target those weak highs. New break of structure to the upside, pullback into more recent. We also created an extreme demand. So in this scenario, if you set a limit on the extreme, you wouldn't have got tapped in. Price instead decided to respect the more recent demand to target our weak highs. But this is where we need to understand where is the daily most likely going to pull back to. Well, a simple and rule-based way to identify this, if we come back to our daily time frame, we take a fib tool, mark it out from the strong high to the weak low, or vice versa, the strong low to the weak high, and set your settings to just the following: a 0, 1, and a 0.5. We have the center, which is called equilibrium. We have the top and the bottom, which we call premium, discount, and equilibrium. Price is always highest probability in a bearish market to pull back into premium of that swing range. And in a bullish market, price is always highest probability to pull back into discount of the swing range. So we know that when price starts to approach the equilibrium of this overall daily swing range, the probability of riding longs in this pullback phase is going to get lower and lower probability, where we again can start to manage our expectation. The probability of the internal, which again is our 4-hour time frame in terms of dropping down from the daily, there is going to be good probability where price can start to shift 4-hour bearish. All right, 4-hour bullish, break, pullback into demand, target at the weak highs. New strong lows, pullback. Instead of respecting the strong low, we broke structure to the downside. We then created new strong highs, pullback phase, mitigation of supply, internal shift to the downside, pullback into supply, new break, pullback into supply to target those 4-hour weak lows, new 4-hour strong highs. After that 4-hour break, what can we anticipate is that 4-hour swing pullback into supply. Internals will confirm to target those weak lows in alignment with the higher time frame daily trend to also target our overall daily weak lows. We know within this 4-hour swing range, it's going to be good probability to anticipate price to pull back into equilibrium and premium of the swing range, which we still have some room to ride these pullback longs. But as price approaches this equilibrium, there's going to be less and less room to ride these pullbacks, where we can anticipate the internal time frame of the 4-hour, which is our M15. I'm going to hop onto that now to confirm a bearish shift with supply and control to target our 4-hour weak lows and also our internal M15 weak lows. All of this in alignment with the higher time frame bearish daily order flow. So let's drop down from the daily to our 4-hour and now finally to the M15, our third structure type, the fractal time frame. So our M15 is the time frame that we spend 90% of our time on. Okay, so we now know in terms of the M15, we've had our previous 4-hour break of structure to the downside. M15 still bearish, M15 break to the downside, pullback phase into supply, new break to the downside, new strong high, pullback phase started, but instead of targeting and breaking structure to the downside, we broke structure to the upside, which would be our expectation because after the 4-hour break, swing break of structure to the downside, we can anticipate a larger 4-hour swing pullback, and we identify that with our M15 time frame. So now we've created an M15 break to the upside, new strong lows, M15 pullback is due to start with our current internal M15 break to the upside, internal strong low, internal weak high. So we're about to mitigate internal strong areas of demand, but we know that there's good probability that this will break structure to the downside to confirm the start of the M15 swing pullback. I've marked out 2 areas of demand, our extreme and our more recent. So my trade plan going into session for today, we now know our higher time frame bias. We're looking to ride the 4-hour swing pullback that is due, and that is now confirmed to start with the M15 swing break. M15 pullback, mitigation into discount demand. Once that internal M15 prints confirm, supply to demand takeover, this will be good confirmation to ride the higher time frame pullback phase. Because we know these demand areas are where the big guy stepped in to create that liquid break of structure to the upside, to confirm the start of our higher time frame pullback phase. Now we could dive further into this as price approaches the extreme discount demand areas of the internal M15 range. We can start to look for mechanical lower time frame 1 minute and 3 minute confirms to target these weak highs to ultimately tighten our risk to reward and really squeeze out those tight RR trades. But that we'll leave for another video. In today's video, we're just going to keep the basics as simple as possible. And all this is about is following the order flow. I mean, even if we take this example over here of this area of supply that also created the break of structure to the downside, if you took an entry from this most recent supply and you got stopped out, it's okay. It's 100% fine. Beautiful. -1. We can then wait for the next trade plan. Okay. Sweep of this liquidity into the more extreme supply, fractal break of structure to the downside, demand now failed, supply and control, there's your next trade. 2, set limits, even if you put your stop loss above that supply and target the weak lows, risk to reward is always going to be on your side when you're trading pro trend. And all this comes down to is the basics. Looking to target our weak lows from our strong protected highs at extreme areas of supply or demand. And a big thing about trading and that a lot of people don't have is they don't have that abundance mindset. The markets are going to be here for the next hundreds of years. There is going to be hundreds of years of opportunities that will print for you to make profits from. So there is absolutely no reason to feel FOMO when it comes to trading. You wait for the high probability setups. They will print themselves. I can show you hundreds of examples of trades that I've taken in the past year of high probability and low probability setups. Some I've missed, some I got tagged in, some I got swept out, and also my full runners that I had. But once you start to see how mechanical and simple this is, you will be on the right side of price 99% of the time. It's going to make your emotions and your patience a whole lot easier to manage. Take my trade plan example from today. Even if this does not play out, let's say price continues with this pullback phase without me completely for the whole week. What I'll do is I'll come into session next week. Eventually, perhaps we've mitigated equilibrium of the overall 4-hour swing range, and we will print that opportunity for the M15 to shift bearish with supply and control, mitigation of higher time frame supply, pull back into that supply. There will be a whole new trade plan for that day to set itself up to target our 4-hour week lows and even potentially our overall daily week lows all the way down here at the daily swing week. And that's how you start to catch these high risk to reward trades, is by following your structure story, the higher probability setups with the time frames aligned together. And even within here, we can look for lower time frame 1-minute confirmation to start really getting those tight, large 50R plus trades. And that's how doable and simple this can get through understanding your structure story, through a simple, mechanical, rule-based way, which all that is needed from you is practice and time to understand this. I'm getting so excited and psyched up talking about this to you because there's so many different POIs that I can show you. But if I had to talk about all of them, this video would be hours long. If we backtrack a little bit, all right, previous 4-hour breakup structure, 4-hour pullback after the M15 shifting bullish, we know we had higher time frame supply mitigation. Even if we look for entries here, just limit on that supply, stop above the high of that supply, looking to target our week lows. Okay, maybe here we had a bit of a runner and then a break even, and we wait for the next opportunity to present itself. New sweep at that high, extreme 4-hour supply mitigation, supply to demand takeover, new M15 supply and control. We can then set limits on this zone. New opportunity printed to target our 4-hour and higher time frame daily week lows. And this sort of thing is going to happen. You're going to get -1s, you're going to get BEs or just swept out, but price is always going to print another opportunity for you. That's the nature of trading. But I can tell you, once you're on the right side of price, risk to reward and risk management will always be in your favor. And even if you're trading internal structure, previous M15 break, M15 pullback, internal shift to the downside, supply and control. Just trading this internal structure. Look how solid the RR is. 2.6R. New break, pullback into supply. Without looking for confirm, just lower time frame execution. 3R plus, new break, pullback into supply. Tagged into your limit. Stop above the high, target that low. Mechanical 2R. New break, pullback into extreme supply. Limit set, stop above the high, targeting those weak lows. A 3R trade, nearly a 4R trade, without even looking at the lower time frame, 1 minute or 5 minutes. And your RR was already high enough and in your favor purely because you're on the right side of price. Now, inside of MM Funded, I document EURUSD, GBP USD, and XAUSD on a daily basis. Those are my 3 primary pairs that I trade. I also hop onto live stream with my members every single morning at 9 a.m. GMT +2, going over full top-down analysis from the daily to the M15 to lower time frame execution. If a plan plays out on stream, we then all execute. So for example, yesterday on EURUSD, our trade plan was to go short from lower time frame areas of supply, which we had mitigation into, sweep of liquidity into the 50% mitigation, lower time frame confirmation printed, and we discussed this on stream. We continued price quite messily. We hit BE in partials and came back to BE later that day. Beautiful trade plan executed, and I will always tell you this, and I tell this to my members as well. No matter the outcome, if you execute your trade based on your set of rules and your plan, that trade is a win, regardless of the outcome, regardless if it's a loss or win. Beautiful. The markets will print a new opportunity and a new profitable opportunity the next day or the day after that. Like I said, the markets are going to print hundreds of years of opportunities to come. There's no reason to feel FOMO. Previously on XAU USD, we had long trade plans on XAUSD. We caught a 20R runner. The previous day last week. The next day, yesterday, we were still long after M15 discount mitigation, internal shifted bullish, looking to stay on that side of price. Internal break, pull back into discount demand, confirm printed, looking to target the weak highs. We ran about 10R and came back to break even on both those entries. Beautiful, 100% fine. This morning, we had a sweep of liquidity into the extreme demand. Fractal change of character happened, still looking to continue long and target those weak highs. New plan is formed, we move on to the next day. If it prints, we execute. If it doesn't print, we formulate a new plan going into session the next day on stream. Also inside of Funded, there's a full 0 to 500K funded membership and mentorship, which is about 100 hours of content teaching you all of this far more in-depth and far more rule-based. Section 2 being the source of trading that has created hundreds of funded members inside of Funded. I can scroll up and show you certificates of my members for years to come. And all these traders are doing is following disciplined rules, following what I teach them here, following them what I've taught you in today's video. The Funded Pro membership goes into this far more in depth, which is this entire mentorship section over here, which I will leave a link down below if you guys want to get access to this. My streams over here, one of my other pro trader streams are over here. There's also the public trading floor for members that are executing their own trades based on what they taught. So Funded is not just a course or a mentorship, it is a like-minded collective growth community with hundreds of people that you would want to surround yourself around if you want to make it in this industry. There's a good saying that goes, the top 5 people that you hang around makes who you are. There are full-time 6-7-figure traders in this community that are here to help you 24/7, including 24/7 live chat with me. There's question channels everywhere. There's my course questions channel, analysis questions, my trading questions channel, my general chat channel, the funding questions about prop firms. And these are the places where I want you to ask as many questions as possible to learn as much as possible. So where I recommend you get started is start off with the full course section over here, and you will click with this pretty quickly within a couple of months. I've even created your entire roadmap to funding success through the methodology that I've showed you in today's video and also inside of Funded. Now, if you guys want to get 30% off of Funded, I will leave a link down below with a coupon in brackets. Just enter that coupon on the checkout. You will get immediate access once you've checked out with that. I look forward to working with you guys. I work very closely with my members. This community has become like my family, not just a community of random people. We're all very close, we all look after each other, and we all guide each other. But without further ado, guys, take care, and I'll see you on the inside.